So let us start with today's session. Today's session is on context and trade timing. A big fundamental mistake that traders usually make, right, when they are just starting out in trading is they think it's all about timing. If you can time your trades well, then success is all yours. This is what is a big misconception most of the traders have when they are usually just starting out or they have been doing it for some time. I'm not talking about like very experienced traders who are doing it for years on end, because they realize that this is not the correct way to do it. Okay. Now, I personally am trading since roughly 2003, full time since 2005. Now you might ask, okay, you have been trading since 2005. Like, are you profitable since 2005? So absolutely not. It was a very, very long journey where I had to, bear a lot of uncertainties, lot of issues, lot of problems, both psychological, financial, to come to a stage where I can now confidently say that yes, I can make money using trading and support my family and have a life of a full-time trader. It was not a easy journey at all, but I am not trying to discourage you here, right? Because if you are just starting out and you are facing some issues with your trading, it might seem like whether this is actually a good option to pursue. Make sense? So traders doubt themselves all the time whether they should be pursuing this trading or they should be looking for other avenues if they are not, becoming successful early on in their trading. Now, it took me almost 12 years to become confident of the fact that I can make money in any kind of market. I have all the requisite tools and market understanding to make money from the markets. Is it going to take you 12 years? I would say absolutely not. Because if someone comes to me and asks me how to trade, and if I tell them that you are going to take 12 years to learn how to trade just like I did, then it does not speak well for my ability to help traders out in becoming, full-time traders. So what I have done is I have compressed all my 2005 or 3 to now 23. So this is almost 2 decades worth of experience. I have compressed it into my courses, or whenever I am speaking, whenever I am, talking, right? I am sharing this whole 2 decades of experience with you guys. Make sense? All right. So that will accelerate your journey and that will put you in a good place very, very soon. You don't have to wait for 12 years. When I'm saying this, I still see many people, many traders who want to become full-time traders. They come to the market and for some reason they are completely fascinated by price. What they do, they go to Google, they go to YouTube, or they read books. All right. Hundreds of them watch countless hours of YouTube videos, go through blogs, thousands of courses available, all those kinds of things they'll go through. And invariably, everyone is highlighting the importance of time. They will talk about price action models, they will talk about systems, and they will talk about setups, all that can give you a few things. One of them is a very high hit ratio. All right. So what they will say is that if you take 10 trades, you are likely to get 7 to 9 out of them as profitable trades and only 3 to 1 trades will be loss-making trades. So they are promising you 70 to 90% of hit ratio. This invariably points towards trade time. So they will use words like, we will tell you exactly where to get in, get out. Once you use our setup, it gives you very high accuracy. All these things they will highlight. Now, if you go to a professional trader, right, say HNIs or banks and, really huge hedge funds and all those kinds of people, and if you just inquire what is their hit ratio. So if they take, let's say 100 trades, how many of those are really profitable? And you will be extremely surprised by the number. And I can guarantee you no one will give you a number which is higher than 50%. It will always be less than 50%. Now you will say if they are right only half the time or less than half the time, how are they able to make money? Okay, that is a wonderful question. Now, how they are able to make money is they are using something called as hedging. So what they do is they take a trade idea, they take a trade. If it does not work out, they will resort to hedging. They will hold on to their position till the conditions become right. Then they will remove the hedge and let the original position run. Or if they feel that their hedge is making more money than their original position, they will get rid of their hedge and they will let their original position run. Now, why is this very simple method is not available for retail traders to use? And the reason is very, very simple, and that is access to huge amounts of capital. and obviously access to good technology. Even if you get hands on good technology, like if you get built TPO software, you are getting like cutting edge technology. But then again, there is an issue, and that is you are only one person. So softwares will help you reduce your workload tremendously, right? If you get a good reliable software, your workload reduces tremendously. What 10 people can achieve, one person can achieve. But then if you go to big hedge funds, they are not employing 10 people, they are employing hundreds, if not thousands of people. So what you need to understand is that you cannot trade like smart money. You cannot be smart money. So what you do then? You cannot rely on timing your trades. You cannot be or trade like smart money. So Dean is basically saying that it's impossible for you to trade. And it's correct if you're just focusing on this, or if you're just trying to be smart money. What you need to do instead is you need to monitor smart money footprints. So you need to go into the markets and you need to see when the smart money is trying to trade, or if smart money has traded, what effect it is having on the markets. Once you uncover the footprints, then all you have to do is you have to be a couple of steps behind smart money. So let's say they are taking these steps and they are going towards success. What you do when the smart money takes their fourth step, you take your first step. And if you become really good, what will happen when they take this fourth step? You will be taking second step. So you will be either 2 steps behind or 1 step behind the smart money all the time. And this is extremely fantastic. This can help you become a full-time trader who can support his family, enjoy a nice life, and do it all with some peace of mind. You can be burning the midnight oil, or you can be wasting your life away with stress and all the hardships. And when will you enjoy your life? So if you want to really do something with peace of mind, you need to understand that you cannot be at this cutting edge. You have to follow the smart money footprints. Now, many people ask me, didn't you use Market Profile? You use VSA. All these are a little bit advanced tools. So are smart money also using these tools? And I'll say absolutely no. Smart money are not using Market Profile and VSA. Then why are we using Market Profile and VSA? Because they are uncovering the smart money footprints for us. Are you getting my point? So why we are going to use Market Profile? Because we are retail traders. We don't have thousands of people helping us. We don't have departments looking after important aspects of trading. Everything we have to do ourselves. So what we need, at least some help which will help us uncover the footprints of the smart money traders, and that is done by the tools like Market Profile, VSA and order flow. That is why we use this to find trades. Now very quickly, I'll go through the LCTR framework very quickly. So in this LCTR, these 4 words, they stand for: T is for timing, and this is where majority of focus of traders is. C is for context, and this simply means what the market is doing in the recent past. So let's say last 2 weeks. What is the market trying to do in the last 2 weeks? Then comes logic, which basically tells you why market does what it does. So let's say market went higher, why it went higher, market went lower, why it went lower. Whatever the market does, why is it consolidating, why is it trending, everything will be answered by L, that is logic. So this is the correct progression. And then last R is risk, but risk is not the last step. It actually encapsulates everything. All these 3 steps, you always have to keep an eye on your risk, right? So how does it proceed? You first understand some core philosophies that help you answer the question why market did what it did. Once you have that answer, then you ask the second question by looking at context, and that is, what is the market doing right now? And once you have answer to that, okay, and again, when I say what is the market doing right now, we are not trying to understand the market actions, we are trying to understand the smart money actions in the market. So the correct question will be, what is the smart money trying to do in the recent past? And once you have this idea, then you go on to your timing. And what is the purpose of the timing? The purpose of the timing is to reduce initial risk. Please understand, note it down, write it down. Timing is not to get in at a perfect time when the market starts to move rapidly. No. The objective of timing or improving your timing is to reduce initial risk. So that, let's say you want to buy 1 lot of Bank Nifty and you don't have enough capital. But if you can reduce your initial risk, your initial stop loss will be low, and which will basically fit into your limited capital, because that is the biggest hurdle retail traders have. Even if they have great understanding, the capital is always limiting. So you can fit in that 1 lot, that 2 lot in your limited capital by reducing your initial risk. And once you do that, then you can take some trades, and that will give you profit, and that will basically help you earn some return on your capital. Okay, so that is the overall process, and the tool that I use for this, there are two tools. One is Market Profile, and the second one is VSA. The third one is obviously order flow. But whether you should be using order flow, whether you can use order flow or not, depends on your time frame. Okay, so according to me, if you are trading from a short swing time frame, so that is you're holding your trades for let's say 2, 3, 4 days, order flow, you do not have to continuously watch order flow chart. You can confirm certain things on the order flow chart as and when required, but you do not have to continuously watch the order flow chart. And even if it is not there, VSA is there and it will help you. Okay, and most of your job is done on this market profile chart. But let's say you are scalping. Now, if you are scalping, then order flow can be extremely useful. But today we are talking about short swing trades, and we'll try to find out what help market profile and VSA can give us. Now, so let us go through this particular 2-3 day fall that happened. I am talking about these 3 days, 1, 2, and 3. So, and why after this nice, extremely bearish candle, why did we not follow through and we are now seeing a pullback? So we will look at this whole price action, right? And we'll also try to see how you could have found some low risk entry points into these trades. Now, first and foremost, you need to answer the question, what is the market doing in the recent past? All right. So you see we are stuck in a bigger range. Inside this range, there are multiple smaller ranges. So if you look at this, you have a smaller range here, right? There is this one day which has gapped out of this whole range. The reason is that war news, right? I think Israel-Hamas, that standoff, that resulted in this sharp gap down, and then market again went back into the range. So for our purposes, we are looking at this range. Now, let us also not look at the bigger range. Let us just focus on the smaller range. So this is the market that we are focusing on. Now, what do we see? We see that market has made some kind of a top, and now it is going down, consolidating, and likely to resume again. That is the natural progression of the market. Now, whenever you are looking at the markets, okay, using option principles or this complete trading framework, what we are trying to look for is unexpected behavior. Now, what is unexpected behavior? See, let's say this is a support and price comes here. What do you expect from the market to do at a support? Get supported and reverse. Let's say this is a resistance and market is coming from below. What do you expect from the markets when it hits a resistance? To go back down. Very simple, right? Nothing complicated. Now, let's say you are in a range. What do you expect from the markets if it goes to the top of the range? Come back down. If it goes to the bottom of the range, come back up. If it goes to the top of the range and does not come back down but just starts moving sideways, is this the expected behavior? No. Comes down, starts moving sideways near the bottom of the range. It is not expected behavior. It is unexpected behavior. Whenever the market is doing something contrary to the expectation, that is expectation as per technical analysis, not your expectation. You can expect market to do anything for you, but market is not going to listen to you. It is going to listen to the principles according to which it works. So whenever you have unexpected behavior, there is a chance that market, in this case, being stuck in a range, breaks out of a range or breaks down from a range. So let us observe this range and see what is happening here. You see market goes to bottom. I mean, this is the first time it creates a bottom, rejects sharply, rejects back down, goes back here, stops for a couple of days, but again comes back down, again goes back, again a big day down. But here what happens? Again here you can see it comes to the bottom, gets rejected, comes to the bottom, gets rejected again, alright? But here what happens? It comes to the bottom, and this time the follow through is not to the upside, it is to the downside. This is unexpected behavior. This is called as absorption of demand in the CTF. Whenever it is at the bottom of the range, we call it absorption of demand. And once you absorb all the demand, where is likely the market is going to go? It is going to go down. Why? Because market goes down to find buyers. Who tells us that? Auction theory. Where can you learn about auction theory? It's in the advanced technical analysis module of my course. Make sense? So this absorption of demand leads to a breakdown. Now let us go to market profile chart and observe this in greater detail. So if I just squeeze everything, what you will find is this range. And this bottom of the range is somewhere in this zone, 19,550 to 19,500. Now with this information, let us zoom in a little bit. Mark our bottom here in this zone, 19,550 to 19,500. It's always a zone, guys. It is never a single reference, okay? Never ever a single reference. Even if I say 19,500, it will never be 19,500 only. It will be plus minus 50, plus minus 100 points. So now we come to this zone. First time we come here, and this is the 19th of October. What do you see? If I split this profile, you will be better able to see. See, this is kind of an expected behavior because market was rejected back up. But first it spends a lot of time here, creates that doubt in the mind, and then mid of the day it goes higher, but it does not continue to go higher. It just moves sideways. Make sense? So what it tells me, like if strong buying is coming here, if this is a strong support, market has to quickly move away from this support. It is not. Okay, fine. That also we understand. What happens the next day? If the buyers are strong, this is what should be happening on the next day. Market should continue to move higher. It does not. It comes back down to that same zone. And this time, unlike this, it developed first consolidation here, and then at least it developed a consolidation higher. Here it just develops one consolidation and does nothing. It just stays there. Now you tell me you are at a support, you are expecting demand to come in, and the price is refusing to move higher. What does that tell you? It tells you that whatever buying is coming at the support, equal or more amount of selling is happening. Now, I'll ask you a simple question. If you observe smart money behavior, what do you think they will do? Will they sell at a resistance or will they sell at a support? What do you think is more logical? Selling at resistance or selling at support? But see, we have been told to sell at resistance. And if you sell at support and market bounces, you will make a loss. But this is a support. And why is someone selling here? Because if they are not selling, then market will go higher. So they are selling here. Now you need to understand the concept of time frames. Like if this is a resistance and this is a long time frame resistance, market comes here, gets resisted, comes down. This is a support, but it is a short time frame support. The longer time frame resistance, once we get resisted here, the smart money is expecting the market to go much lower. So when they encounter shorter time frame supports, they will still sell and push the auction lower. That is how we know that higher time frames are interested in selling, and whatever shorter time frame demand is coming in, like it came in here, it is now overpowered and it is going to go much lower. Even though it is correct that you should sell at resistance and buy at support, if this is a short time frame support and this is a long time frame resistance, this will not hold. And that is the reason why we always say trade in accordance with the higher time frames. Anyways, let us draw this again. So now what is happening? We are finding a shorter time frame support where higher time frame or longer time frame sellers are selling. So anyone who's trading from shorter time frame trying to buy here would not be able to support the price. This is the conclusion we draw from this unexpected behavior. Unexpected behavior, we can draw a lot of information like this, and that is the beauty of market profile. Alright, this pattern has a specific name. This day has a specific name. I can go into details and then we'll have to talk for almost a month, because that is how long my intensives were. I conducted intensives daily sessions for 1 month, 30 days, 35 days, and then the CTF courses has come out. Alright, so if I go into all the details, this session will never end, but we have a limited time. We have 1 hour. So I want to give you one specific concept which you can try out in your software. Like if you are one of my course subscribers or planning to join my courses, you can get a 1 month trial and you can practice this one thing at least to start with. Support, short term frame support, higher time frame selling happening. What is the expected behavior here? Was that market will go up, but it does not. It goes down. Now is the time where action is required. If you were trying to sell in any of these days, here, there is very little probability of success. But the moment you see something like this happening, after an unexpected behavior, this is your high probability zone. Why is this high probability zone? So first you need to look at a few things on a market profile chart to confirm that whether this breakdown is a high probability breakdown or not. First and foremost, always remember, if sellers are in control, the first thing you need to see is whether we are taking out yesterday's low quickly. Is it difficult to understand? It is very simple. Are we taking out yesterday's low quickly? Quickly as in the first half an hour or at max in the first hour. Let us look at this. Each letter represents 30 minutes. So by this time you should be aware of this market profile concepts. So as soon as you take out yesterday's low in A period, the first condition is met. You have taken out yesterday's low quickly, and that gives you confirmation, at least one confirmation, that yes, sellers are in control. Okay, you're not satisfied with this? Let us take one more step. Second thing that should happen is we should get range extension within initial balance. That is, A and B period gives you the IB. What do you need to do? You need to see some range extension in initial balance. Now in this case, to the downside. And what do I mean? If A period is forming, B should go below the low if sellers are in control. Does it happen? Absolutely it does happen. B goes below A period. Then you should see CDE, any of the CDE period to continue to move lower. So immediately we get C period moving low. Now this is 90 minutes into trading. We have strong confirmation that market is likely to break down. Now if you look at this point, that was 19,550. If you look at this point, this is where, let me just check once the level, exact level, 19,420, let's say. Okay, so this is 19,550, this is 19,420, this is 130 points lower. 130 points lower, you are getting confirmation that yes, sellers are in control. Do you think you will be happy to sell 130 points lower when you have seen markets trading 100 plus points higher just on the previous day? Everyone will think that this is overextended, this is oversold, you should not follow the price or you should not chase the price, right? All these kinds of things will be coming to your mind. This is what is being taught in all the traditional technical analysis books. But what we saw the unexpected behavior. We saw a big range which we were breaking. Makes sense? So the context was bearish. And if the context is bearish, forget about these kinds of situations, because 130 points is just the beginning. We are going to fall much more. Still, if I tell you just sell here, put your stop loss here, what is the point, right? What if it comes here, hits your stop loss and then goes down? So are you again supposed to sell 130 points lower? Okay, so you take first trade, hits your stop loss. Are you supposed to take second trade here itself and again put your stop loss here? How many times are you going to do this dance? How many hundreds of points are you happy losing just to get one good trade? That is not the correct way to do it, right? So what we were doing, first we saw higher time frame picture. Then we got an idea that okay, some unexpected behavior is happening. Then we come to the market profile chart where we are trying to understand the context, what is happening in the recent past, last few days. And on this day, what we understand is there is going to be a breakdown likely. Makes sense? So context also is telling you that yes, everything is bearish. Now what you are going to do? You have the logic part understood, context part understood. Now comes the timing part. If you just look at timing, there are hundreds of places where timing was good. But did the trade work out? No. Why? Because context was not supporting, logic was not supporting. Once you have trading logic understood, you have understood the current context, and you are playing in the direction of the context, you are using timing principles in the direction of the context, the likelihood of success in trading increases dramatically. And you will avoid trades that go against this logic and context. So let's say there is a beautiful entry setup coming in here for long trades. I'm not saying it is happening, but let's say it is happening. And when you look at logic and context, what it is telling you that no, this is looking bearish, this is not looking bullish at all. What you will do with this particular setup? You will ignore that. And that is how your mistakes are going to go down. That is your first objective as a beginner trader. Reduce your mistakes. The moment you reduce your mistakes, your profits will soar. Just a few days ago, someone in Discord group told me that they made some 70 odd K profits, but they also made 60 odd K losses. So when they combined, they had some, I think, 5K odd profits in the last month or in say last few months. So now imagine these are profitable trades, these are loss-making trades, and if you can avoid a few of these mistakes, let's say this 60K comes down to 35K, immediately this 5K profit is going to jump to 35K. That is a 7 times increase in what you are making a month, or let's say in 3 months or whatever it is. Now, I'm not promising these returns or I'm not promising these results, but what I'm saying is that if you follow the correct path of first reducing your mistakes, your profitability is automatically taken care of. So please follow the correct path. Go after logic and context. Let the markets tell you what they are trying to do. And once they have told you what they are trying to do, then you jump into the big T, that is timing your trades. And this is where market profile can take help from VSA. Let us go to a VSA chart. So this is a 3-minute VSA chart, right? I'm looking at a short-term VSA chart because I am coming to this VSA chart only and only after I have confirmation that market is going to go in a particular direction. If I straight away jump to a 3-minute VSA chart, it is very difficult for me to consistently find good trades. This is the day that we are talking about, October 23rd. And we need to enter somewhere in the early part of the day. So what we saw that first the A period took out yesterday's low. Now 10 small bars will give you 30-minute candle. Then what we see, okay, A period has taken out yesterday's low quickly, good. And we already had that unexpected behavior context behind us. So this is a bearish development and which is good for us. Now, you see B period also tanking low. Great. C period also tanking low. Excellent. What is left to do now? Wait for a good pullback and you sell. Okay. Where should we sell? How can we reduce our risk? Dean, tell us. The best place to sell is at the VWAP. Best place. Why? Is it because VWAP is a great resistance or support? Many people will tell you, okay, it is a great resistance, great support. Price will always respect VWAP. No. What did I tell you? What is the purpose of timing? Did I say, okay, this is exactly the point where market will reverse? No. What did I say the objective of timing was? What do you think smart money is using timing for? Reduce initial risk. Please write it down in your book, or I don't know how you will remember this. Paste it on a wall in front of you, on your monitor, make it a screensaver. I don't care, or you can get a tattoo also. We only want to reduce initial risk with timing. We are not here to catch this exact reversal. That is stupid. That is stressful. That will give you sleepless nights and you won't be able to enjoy your trading profits. Okay, so what is our objective? Reduce initial risk. How do we do that? What we saw, A period extended range, B period extended range, C period extended range. All this is extremely bearish. 100, 150 odd points covered. What are we supposed to do? Wait for a pullback. What are we going to look on a pullback? First, does it go to VWAP? It does not go to VWAP. But is VWAP trending in the direction where you want to take a trade? So you want to short. Great. Is the VWAP trending down? Yes. That is a very positive sign. Now you go to this and try to find out some VSA principles. Now, when the market is falling, most of the times you will see green signals on the chart. But these green signals are for buyers. Yes, they are for buyers. What are they telling you? VSA says that buying always comes on down bars, selling always comes on up bars. This is the simple buy low, sell high principle which the smart money follows. Okay. So as the market is going down, it's in a downtrend. Naturally, the software will plot a lot of green signals, and that is the way it should be. But are we going to give importance to these? No. What are we going to look at? Some small number of red signals that are coming. So what you want to find out is a place where either of these two things are happening. If there is strong selling or there is weak buying. All the red circles highlight weak buying. All the arrows, triangles, these triangles, these arrows, they highlight strong selling, and vice versa for the green. Forget about this strong buying and all. This is not going to cause any problem to us because context is bearish and we have bearish development. VWAP is bearish. Alright. So forget about the strong buy signals. Strong selling or weak buying. Red dots, weak buying. Any arrows or triangles, strong selling. Once you have the context nailed, once you wait patiently for this, most of the signals will work. So as the market is going higher, what do you see? This bar, weak buying. This bar, weak buying. Where do you enter? Below the low of any of these bars. Okay, so what do? You wait patiently. A period range extension, B period range extension, C period range extension. I have followed all the Dean's suggestions. Now the market is pulling back, but it is not going to VWAP. Fine, but is VWAP trending down? Yes. Then what you do? You focus on these signals, and then you get a signal where you can short below the low. Once you enter here, now where should you keep your stop loss? Let us first put some numbers on these levels. So let's say the low here is somewhere close to say 19,445, and what is the VWAP at that level? 19,475. So take 40 point stop loss. 45 is your entry level, 85 is your stop loss. Now when you put stop loss at 85, somewhere here, where is it? Is it above VWAP or below VWAP? It is above VWAP. Make sense? So what are we doing? We are also putting another resistance or important reference between our stop loss and current market price, which has given us the confirmation that there is weak buying now. It's not likely to sustain. Do you have to put your stop loss here? No. Can you put it exactly at VWAP? Yes. Is there a likelihood that your stop loss might be run? Yes. Can it take a stop loss at 85 also? Yes. Is it a foolproof system? No. Is it guaranteed that when Dean or his VSA system tells you to buy or sell, you're always going to make money? No. This is not that kind of session. We are not here to sell anything to you. Do I have courses? Yes. Do Buy TPO have products? Yes. Do we want people to join us? Absolutely yes. But is that our sole objective to do? No. We don't want to push our products. They are useful. They are valuable. If you find value in it from these free sessions, if you want to dive deeper into it, then we are available. We are not going to put hoardings in every intersection and compel you to join our courses. No. If you find it helpful, you come, you join. Otherwise, you can continue whatever you are doing right now. If that works for you, I don't want you to change anything. We put here our stop loss here just to give it an additional room so that market does not take our stop loss out and resume its original direction. Putting small stop loss is one of the major reasons why retail traders struggle. So if some smart money is trading here, do you think where they will be putting their stop loss? They will be going far away from the markets. Let me ask you a question first. Do you think if you have put your stop loss here, you have to wait till your stop loss is hit to get out of your trade? The point here is that you do not have to wait for your stop loss to be taken out. Stop loss is a level which is a last resort to get out of your trade to protect your capital. It is not a part of your trading plan. It is a disaster management system. It is not a trade management system. Why the smart money will put their stop loss here? Because before hitting their stop loss, market will be trading above VWAP. Before hitting their stop loss, market may be pulling the VWAP up. Before hitting their stop loss, when the pullback comes to VWAP, they probably have reversed their position or hedged it sufficiently so that even if market goes to higher levels, it is not going to cause them trouble. That is why smart money does not have to win on every trade to make money. But for retail traders, what are you supposed to do? You put your stop loss at a safe distance so that even if it goes here, tests the VWAP, goes a little bit above VWAP and then fails, your trade is still safe. So you do that, you enter and then you watch the market fall. Now, how far do you think the market is going to fall before you think about booking profits? Another big problem with retail traders is they book profit easily. So market goes lower, closes nicely here. Next day opens higher, you panic, you book your position here only to see market fall again. Again, a late rally happens, you panic, you book your position only to see market fall again. This time you say, no, market has not given a late rally. It is also closing below VWAP and I'm going to hold my position, and next day market gaps up and you lose a big chunk of money. So why you should not book your positions here, but why you should book your position here? That will be the last part of this puzzle, and the answer lies in higher time frames. So do you have to go here? No, nothing is on the left hand side, because how many days can you cramp in? Still nothing on the left hand side. This chart is not readable, right? You cannot read anything. So you need your chart to be readable. So what do? You cannot find anything on this chart also. Where do you go? Go to even higher chart. This is the daily chart. Now when the market was falling lower, you had this HVN, which was an important support because it provided support first. It was broken. We went below that. Next support was these clustered lows. We broke it on the second day. Then comes the big support, the big HVN, this balance. You are not going to look at intraday developments on these days or these days to find good support and resistance. No, when you are trading higher time frame, you are looking at broad levels, not specific levels. So what is happening here? We take out this low on first day, take out this particular low on second day, and then we come close to this HVN. As soon as you come within the striking distance of a long-term HVN, which is also the last point of demand, another key concept in the complete trading framework. You book your profits. Now, let us go back to that particular day, that particular situation. Now here, let's say somewhere here is 18,800, right? So you can see it on this chart. This is your long-term support. Market is so close to it, and you can see market stopped making new lows after this point. Where can you find this information a little bit better and easy to read? Go to the market profile chart. Let us split this chart. This is that day. Market opens lower, takes out previous day's low. Great. That is what we expect. B period range extension. Great. Hold on to your trade. C period range extension. Great. D also extends the range. Excellent. A pullback is going to happen. That is, the pullback happens. Where does it go? VWAP. Sell at the VWAP. Let the markets go down. Now is the decision point. When you pull back to VWAP and you sell and market goes lower but does not find acceptance below the morning low or previous low, this is a warning sign. IJKL, nothing. Another pullback happens to VWAP. Are we again coming and making a new low? No. And the low should be decently lower, like not just touching this. On 5-minute chart, you will see that we have gone a little lower, but not that little. You need to see good progress, 1 or 2 TPOs at least. Not happening. Warning sign. Where is it happening? Do we have a long-term support in picture? Oh, yes, we are very close to that. So we go to this chart. Let us mark that 18,800 level again and see what is happening here. Pull back to VWAP. Sell. Does it make a good new low? Not just come to that vicinity and stalls. Come to that vicinity and stalls. Second attempt, come to that vicinity and stalls. What is it telling you? Trade facilitation has become poor. Trade facilitation, another important concept in CTF. And as soon as you get this, you protect your capital. How? You book your profits. You book part of your profits. Or if you are an advanced trader and you have sufficient capital, hedge. So even if market goes higher unexpectedly next day, you are not losing your accumulated profits. And you can get out even in this zone despite market going against you because you have hedged your position. Now, how to hedge is a little bit out of the scope of today's webinar, but how to book your profits, you know that. If you have puts, you cover them. If you have future shorts, you cover them. How to part book? Let's say you have 5 lots. Already you should have booked some here, and rest of the position you can book here. So let's say 1 here, 2 here, hold on to last lot. If it goes against you, okay, book it the next day. Take some loss on the last lot, but it will confirm that it's not continuing in this direction. Make sense? Let's say you have 5 lots of futures. You have booked some here, and now let's say you have 2 lots remaining. What you do? If you want to hold on to this, buy some puts. So next day if market gaps up, put will make profit. That will offset some losses on your future. Get out of the whole position and enjoy your profits. That is how a complete trade is planned and executed. All right. And these principles, they work on all liquid assets. These will work in almost all markets. See, good stocks, liquid stocks, commodities, currencies, whatever you are trying it on, it will work. So this is the way you can combine market profile with VSA to find good entries. And these topics are covered extensively in the complete trading framework.